Hi, everyone. My name is James Gravino, and welcome to my podcast, The Current State of the U.S. Economy. In today's episode, we're going to break down 4 key indicators that help us understand where our economy stands right now: unemployment, economic growth, inflation, and the current account. By the end, we'll have a clearer picture of whether the U.S. economy is healthy, slowing down, or somewhere in between. Let's get started. Let's begin with unemployment, one of the best measures of how ordinary Americans are doing in the job market. As of October 2025, the U.S. employment rate is sitting around 4.3%. According to the Bureau of Labor Statistics, that's slightly higher than the ultra-low levels we saw a couple of years ago when unemployment dipped below 3.5%, but still much lower than during a recession. So how did we get here? Over the past year, the Federal Reserve's higher interest rates have cooled the economy a bit. Businesses have slowed hiring because borrowing money became more expensive, and consumer spending has eased slightly. Sectors like healthcare and professional services are still adding jobs, but manufacturing and energy have slowed down. Is 4.3% high or low historically? It's actually quite normal. Economists usually consider anything between 4 and 5% to be the full employment. So while the labor market is cooling, it's far from collapsing. Now, let's talk about how fast the economy itself is growing. Our GDP, or gross domestic product. In the second quarter of 2025, U.S. real GDP grew at a rate of about 3.8%. That's a big rebound from the first quarter, when the economy actually shrank by about 0.5%. So what does that mean? Overall, the U.S. economy is still in an expansion phase, not a recession. Not a recovery from one, but a modest expansion. Is this a healthy rate of growth? Yes and no. On one hand, 3.8% growth is strong. It shows consumers are still spending and businesses are investing. On the other hand, such rapid growth may not be sustainable long term, especially with interest rates still relatively high. Economists often view a steady 2 to 2.5% as a sweet spot for a mature economy like ours. So right now, the U.S. economy is growing, but the pace may slow down again as the effects of past rate hikes continue to filter through. Next up, inflation, probably the most talked about economic topic of the past few years. In August 2025, inflation was about 2.9% year over year, up slightly from 2.7% in July. That's a big improvement from the 8 and 9% inflation rates we saw back in 2020, but it's still above the Federal Reserve's target of 2%. Is that too high, too low, or just right? Well, it's not disastrous. Prices aren't spiraling out of control, but it's also not quite just right. It means that while inflation has cooled, it's still a bit sticky, especially in categories like housing and services. So, what should the Federal Reserve do? Right now, the Federal Reserve is being cautious. They recently cut interest rates slightly to a range of 4 to 4.25%, but they're likely to pause before cutting much further. If inflation starts to rise again, they might even consider holding or tightening policy. The goal is balance, keeping inflation under control without causing a sharp rise in unemployment or pushing the economy into recession. Finally, let's look beyond our borders at the current account, which measures the flow of goods, services, and income between the U.S. and the rest of the world. Right now, the United States is running a current account deficit, meaning we import more than we export. In the second quarter of 2025, the deficit was about $251 billion, or roughly 3.3% of GDP. Is that bad? Not necessarily. A deficit like this isn't unusual for the U.S. We've run one for decades. It partly reflects that Americans buy lots of foreign-made goods, and the U.S. dollar is strong, which makes imports cheaper. The upside is that the U.S. can attract foreign investment easily, since global investors view our economy as stable and our assets as safe. But the downside is that large, persistent defects can make us more dependent on other countries for financing, which could pose risks in the long run. Overall, the current account deficit isn't an immediate problem, but it's something economists keep an eye on. So to wrap everything up, unemployment is at 4.3%, showing a cooling but still strong job market. GDP growth is around 3.8%, signaling a moderate expansion after a slow start to the year. Inflation is at 2.9%, slightly above the Fed's target, meaning prices are more stable than before, but not perfect yet. And the current account shows a continuing deficit, which is typical for the US, but worth monitoring for long-term balance. In short, the U.S. economy in late 2025 is in a stable but delicate position. Growth is solid, inflation is easing, and jobs remain plentiful. But risks remain if global conditions shift or inflation picks up again. Thanks for listening to my analysis of the current U.S. economy. If you enjoyed this episode, don't forget to like, share, or subscribe, and stay tuned for more updates as the economy continues to evolve.